Dirty dealings, corporate battles, consumer woes. This is Evening 5. Petroleum National posted a 10.5% drop in the first quarter from a year earlier, while flagging a prolonged volatile pricing landscape. Net profit came in at 21.3 billion compared with 23.8 billion a year earlier, despite revenue edging up 0.4% year-on-year to 89.7 billion from 89.3 billion previously. Going forward, Petronas expects increasingly difficult headwinds for the remainder of the financial year, said President and Group CEO Tan Sri Tengku Muhammad Taufik. He adds that the national oil firm will leverage the strength of its integrated portfolio to reinvest. Petronas has a clear strategy for the energy transition, namely developing hydrocarbons with measurable and effective decarbonization initiatives and pursuing cleaner energy solutions, he explains. Capital expenditure stood at 10.72 billion, up from 10.49 billion a year earlier, which went into gas and upstream projects, including the ongoing LNG Canada, La Amarga Chica in Argentina, as well as the nearshore floating LNG project and Kasawari carbon dioxide sequestration facilities in Malaysia. Petronas' domestic spending rose 20% to 5.5 billion from 4.6 billion previously. In first quarter FY 2024, net profit at its upstream segment slipped 8.6% to 11.32 billion as higher product costs, operating expenditure and cash payments offset the 6.8% increase in revenue to 38.11 billion, which was boosted by currency gains. According to Petronas, the ONG market remained affected by the instability of the macroeconomics and geopolitical dynamics amid the energy transition for the first quarter, which led to a prolonged volatile pricing landscape. As for the downstream segment, net profit climbed 16.5% to 1.92 billion, mainly driven by lower product costs. Revenue, however, declined 6.9% to 44.69 billion from 48 billion previously on lower selling prices and volume. CIMB Group Holdings saw its net profit grow 18% year-on-year to 1.94 billion for its first quarter, as both interest and non-interest income grew faster than cost and provisions. Net interest income grew 7.7% year-on-year to 3.79 billion, while non-interest income surged 24.5% to 1.84 billion ringgit. CIMB did not declare any dividend for the quarter under review. CEO Dato' Abdul Rahman Ahmad said that CIMB expects its key operating markets to be resilient and well-positioned to capture economic growth, especially from the positive impact of increased tourism economy. Overall, he says the bank is optimistic of being on track to deliver its FY 2024 targets on the back of positive performance from Malaysia and Singapore. For the year, CIMB is targeting 11 to 11.5% ROE and achieved 11.4% in the first quarter. During the quarter, provisions for bad loans and other credit losses rose 13% to 503.26 million, while operating expenses rose nearly 9% to 2.55 billion ringgit. The net interest margin, a measure of profitability from interest charge on loans after deducting returns paid to depositors, narrowed 8 BPS to 2.18% on lower cost of deposits in Malaysia and improved Indonesia loan yield. Current account savings account growth stood at 16.8%, while gross loans and financing grew 7%. CIMB is targeting 5 to 7% loan growth for the whole year. Common Equity Tier 1 capital, which measures a bank's capital strength, improved 70 BPS to 15%, above its own target of at least 13.5%. CIMB said it will continue to focus on strengthening its deposit franchise, net interest margin management, and driving net non-interest income expansion, as well as ensuring digital and operational resilience. The government will implement a floating diesel price mechanism alongside targeted diesel subsidies to curb fuel subsidy leakages, which have become increasingly prevalent. Finance Minister Dato' Sri Amir Hamzah Azizan said diesel subsidies, which amounted to 1.4 billion in 2019, surged tenfold to 14.3 billion last year due to several factors, according to a Bernama report. He highlighted that the consumption of subsidized diesel rose from 6.1 billion litres in 2019 to 10.8 billion litres last year, marking a 70% increase. He noted the disparity between the retail price of diesel at 2 ringgit 15 per litre and the market price of approximately 3 ringgit 50 per litre, which some parties exploited for profit. Additionally, fuel price differences with neighbouring countries such as Thailand, 4 ringgit 12, Indonesia, 4 ringgit 73, and Singapore, 8 ringgit 87, created opportunities for fuel smuggling from Malaysia. When asked about the implementation timeline for the diesel subsidy mechanism, he suggested that it could be this year but did not provide specifics. The estimated savings of 4 billion from the targeted diesel subsidy implementation are expected to give the government a larger fiscal space in efforts to increase the quality of various services that are important for the people. Tenaga Nasional's net profit for the first quarter fell 28.6% to 715.7 million due to foreign exchange translation losses and higher tax expenses. In contrast, revenue rose 8% to 13.64 billion during the quarter from 12.63 billion previously. No dividend was declared for the quarter. TNB said that the higher revenues were driven by electricity demand growth of 9.9% year-on-year, consistent with the country's GDP expansion of 4.2%. Nevertheless, the utilities giant said the imbalance cost pass-through under recovery fell to 2.35 billion from 3.63 billion in the same quarter the prior year due to lower generation costs during the quarter. On its prospects, TNB said with the Malaysian economy projected to grow between 4 and 5%, the group anticipates a stable performance for FY 2024 while remaining cautious about challenges and taking prudent measures to ensure resilience. The group also reaffirmed its commitment to play an integral role in supporting the National Energy Transition Roadmap. CIMB Plantation, the world's largest palm oil producer by acreage, said on Friday its first quarter net profit tripled from a year earlier thanks to lower tax and strong downstream operations. Net profit for the quarter came in 211 million compared to 69 million in the same period last year. Revenue rose 6.7% year-on-year to 4.34 billion ringgit. No dividend was announced for the quarter. In the near term, CPO prices are expected to remain supported due to continued geopolitical tensions and the anticipated effects of extreme weather events in producing countries, which may impact supply of vegetable oils globally. The company also sees continued growth in fresh fruit bunch production in 2024 thanks to concentrated efforts to rehabilitate its Malaysian upstream operations and accelerating its mechanization and automation efforts. SDP, which will officially change its name to SD Guthrie beginning June 5th, said in a separate statement that it will focus on reducing costs through various transformational initiatives and to drive operational excellence. The planter said that it also remains committed to pursuing new opportunities for business growth. FFB production rose 9% to 1.98 million tonnes in the first quarter, driven by strong recovery of its Malaysian operations. Average realised CPO per tonne slipped to 3,880 ringgit from 3,887 ringgit in the first quarter of FY 2023.